Hey everyone, I'm really sorry for the delay in releasing this video. It takes a lot of time to go through all the results in detail to ensure that I don't miss anything. I hope all of you are having a great day and are ready to review Aurora's Q3 results in depth to see if the company is deserving of this meteoric rise in their share price that they've seen over the past couple of days. So I just wanted to take some time really quickly to show you how some institutional investors can occasionally make purchasing decisions. In my previous video, I mentioned Aurora's net asset value in bankruptcy or insolvency is around 60 cents a share. And if we adjust that for the 1-for-12 reverse split, it's about $7.2 per share. On Thursday, May 14th, when Aurora stock hit about $7.50 a share, there was a spike in institutional buying as the risk to return parity of the stock began looking attractive to some investors who specialize in distressed assets. So if you're looking for an entry point in distressed companies, a net asset value analysis can help target an approximate range to buy into the stock. I, however, would have only considered purchasing the stock at about 40 cents a share or about $4.80 reverse split adjusted. This would give me a 33% margin of safety on the assets. I like buying like this because I don't buy into the long-term outlook of Aurora, and I prefer buying stocks without significant liquidity risk. Anyway, let's start going over the highlights of Aurora's recent quarterly report. First, I mentioned in my previous video that Cannabis 2.0 and the consumer segment were going to be key metrics to watch as they are key aspects of the turnaround story for Aurora. Here we see that Aurora did deliver some strong results in this segment with 24% revenue growth over the prior quarter. However, we always want to look at the full story. A potential concern here is that we could see these Q3 results actually cannibalizing some of the strong Q4 results we typically see due to, of course, 420. The global issue may have created an incentive for customers to purchase sooner rather than later. This is due to the fact that many dispensaries have had to close their doors and governments have been issuing strenuous stay-at-home orders. However, this is just speculation based on a cannabis software firm named Kova reporting 50% slower sales volumes, 54% lower gross margins, and a 50% decline in overall traffic relative to April of 2019. There wasn't only negative news, however, as the average order size this year was 17% larger, and some owners of dispensaries have actually reported strong increases in sales. We do also know that the OCS and other government-based sales mediums were fully operational, so it's possible that the LPs, which are considered essential businesses, were not as greatly impacted by this global issue as the dispensaries. The key number we need to consider for the model is the overall revenue number to see if Aurora is likely to over or under deliver on our expectations. The 9-month ended revenues are about $203 million in Canadian, and if we assume that Q4 of 2020 achieves similar results as Q4 of 2019, given the seasonality that I talked about before, and if we add 10% growth on those figures despite the lockdown and stay-at-home orders, Aurora still only achieves a total revenue figure of about $311 million. So let's take a look at what we assumed in our model. There, we assumed $415 million in the base case scenario. This means that the model already expects exceptional revenue growth in the short term. What's interesting to see is that Aurora seems to be performing closer to our weaker projections in the stable, volume, and low price scenario. This is likely because a lot of the firm's sales were driven by the launch of their daily special and through their value brands, which will likely put additional downward pressure on average selling prices. Second, something troubling to see is that the company's gross margins were not improved during this quarter despite lower cash costs to produce the dried cannabis and the increased sales of the higher margin 2.0 products being included. This is not something I expected as it goes against some guidance management has given regarding the direction of gross margins. Management has also noted in the earnings review that price competition has increased, which puts further strain on their margins. Third, we saw Aurora reduce SGA expenses to roughly $80 million, about $75 million if we exclude the one-time severance expenses. This is impressive to see as it shows that the company has realized the urgency of the cost-cutting measures they need to take. However, the full picture shows that Aurora is still spending slightly more than what we budgeted for them in the initial model. I had expected about $60 million in SGA, but the actual results were around $75 million. Aurora also exceeded my severance payments budget by about $1 million. Essentially, once we factor this into the model, the big picture will look a little worse than we had initially predicted for Aurora's fixed costs in 2020. Fourth, Capex came in at about $73.7 million in Q3. This was good to see as this was a significant reduction relative to previous quarters. However, in the model, I expected management would be able to bring Capex down to $55 million per quarter. Unfortunately, they're spending more than I budgeted in the model. However, management says they're still on track to achieve $100 million overall Capex spend in the second half of their fiscal 2020 year. So I may adjust my Q4 estimates down to meet this guidance. Management have also planned to reduce spending in Q1 2021 to levels far below both Q3 and Q4 of 2020. This fits with their picture of worrying about near-term results. But as an investor, you need to make sure that the company you're invested in does not fall behind in market share over the medium term due to this. However, in Aurora's case, we saw that they really had no choice given the dire need they had to conserve cash. To test this out, we can eliminate the strategic Capex assumptions to see what Aurora's implied intrinsic value could be if they do manage to eliminate most of their Capex expenditures. Finally, the cash burn that Aurora sees did decrease in this quarter versus the past. This is a very good thing, but again, this was expected by most intelligent investors as we knew that if they didn't manage cash flow, they would be going bankrupt really quickly. However, I expected that they would need to rely on their ATM equity issuance to get through the quarter, which again is extremely dilutive to current shareholders. And we did see that the majority of their cash inflows to manage their loss from operations did come from these ATM issuances. Something else that bothered me from a cash flow perspective is management changing past guidance about future ATM usage. Management previously said that they would not need to issue any additional equity through the ATM, but here we see that they've exhausted the previous cap and have authorized some additional ATM balance. The reason why this is troublesome is because it paints the picture that management is still okay with diluting shareholders and that they may have to use this issuance to pay off any debt that they can't recycle. You can rewatch the old video I made if you want to see why this looks problematic to current shareholders. The final issue I had here is that they didn't provide enough color in the cash flow statement. The working capital change appeared to generate cash for the company, but inventory balances went up. It seems as though the company is showing that this was cash generating, but has included the sale of their marketable securities, restricted cash use, and other asset uses here. This is a little misleading, and I would have appreciated if the company provided all the line items separately for this quarter, as opposed to only a 9-month statement of cash flows. Now let's look at the changes I made to the model. We'll start by looking at the revenues, which I decided not to lower just in case Aurora absolutely crushes the next quarter. But we will actually edit the SGA and Capex expenses to reflect the true expenses the company incurred. So both of these expenses happen to be lower than I had predicted, so we will actually see Aurora's value be lower than what I had initially expected it to be in the model. So here we take a look at the SGA expense. This was the number that I had actually come up with based on guidance from equity research and from management's earnings calls. However, this is looking like what the true value for 2020 will be if management can meet its guidance target for the next quarter. Further, the severance payments were actually missed as well. Management incurred something close to about $5 million in severance expenses, whereas I expected closer to about this amount based on the amount of employees that they had let go. Further, we go to Capex, where this again was based on guidance from management and equity research. This was originally what I had expected, but this is looking like what they're actually going to incur as long as they can meet guidance from Q4. However, it could actually be lower, as management's new guidance seems to be that they're going to have an extremely low Capex amount in Q4 of 2020. So we could actually be seeing something closer to this figure. Further, I decided to remove the strategic Capex that I had placed here, which I thought management would have to incur in order to remain competitive in the changing environment. However, management seems to think that they'll be fine without that Capex. So I will remove it just to see how much the value of Aurora's equity actually changes based on the removal of this Capex. We also needed to make some edits to the diluted shares outstanding in the model to ensure that we are seeing an accurate shares outstanding figure. So first, I adjusted the fully diluted shares for the 1-for-12 reverse split. So I just divided that fully diluted shares by 12, and then I also, changed my average figures by the 12 just to see what the prices would have looked like in the past based on, the reverse split. Another change that we know did actually come to fruition was that the company did issue that additional ATM issuance. So Aurora did actually engage in some at-the-money financing activity during this quarter in order to stay liquid, and we know that they issued shares at an average price of about $17.95, which led to about 11.5 million new shares being issued, and that brought the fully diluted ending shares balance to about 113 million shares outstanding after being adjusted for the reverse split. So this then flows into that discounted cash flow. Based on our changes that we've implemented to the model, we still see that Aurora is losing a significant amount of money from an unlevered free cash flow basis until, of course, the terminal value here. Finally, we come to our discounted cash flow analysis, which will tell us what the true equity value per share is for Aurora. And it seems that from an earnings perspective, they're looking at an equity value per share of about -$3, and this is truly because of this massive shares outstanding figure that they have, which really does dilute the equity value per share. And it seems that because their equity value is negative, that additional equity issuances are actually anti-dilutive. But this is counterintuitive because once the company does start making money, you don't actually want to be sharing that pie. So this basically tells us that the recent rally in the stock price likely isn't due to the improved earnings potential, but it's rather due to a lower likelihood of insolvency. So remember in my previous video, the NAV fell from approximately $2.99 per share to about 60 cents per share due to the costs of bankruptcy and the impact bankruptcy has on a company's assets. So if the company doesn't face bankruptcy, the NAV stays closer to that $3 per share mark. However, the reason I would still stay away from the stock is due to the management team continuing to dilute shareholders. After we account for the ATM issuances in this quarter, the NAV actually falls to $2.57 with no risk of bankruptcy. So these figures are not adjusted for the reverse split. All you would have to do is just multiply them by 12 to see the figures post-split. Many retail investors also fail to see how impactful share issuances can be on the fundamentals of a company. In this case, the share issuances in this quarter alone reduced the net asset value of Aurora by 14%. So even though the net asset value was falling from a fundamental perspective, because the risk of bankruptcy was lower, the share price actually increased. So I'm clearly still not a buyer here of Aurora stock. I could consider buying assets at a discount as there is less downside risk, but I would not buy Aurora on the hope that this company will deliver strong earnings now and into the future. I think there are far better companies like McDonald's, Microsoft, Apple that all offer far more attractive earnings potentials that I've added to during this setback. And I've actually been able to obtain my margin of safety on those earnings as well. These companies can deliver strong returns while also allowing me to look at them on a yearly basis as opposed to a quarterly basis, given their established management teams and low risk of insolvency or material harm. So I hope you guys have enjoyed this video and can see that sometimes good earnings reports are not always a certainty that the underlying fundamentals of the company have drastically improved. Finally, always remember to be eager to learn, willing to invest, and prepare yourself for success.